Disclaimer.
Most people are watching the silver price chart. They're looking at the wrong screen. While you were distracted by the $120 breakout, the most important plumbing in the global economy just officially ran dry. As of this morning, the Fed's reverse repo facility, the last $2 trillion cushion for the US dollar, is at zero. But it's worse than that. At 2:47 a.m., a single geopolitical move didn't just rattle NATO, it triggered a collateral blackout. Lloyds of London is reportedly pulling sovereign debt insurance for 12 major nations. If you can't insure the debt, you can't use it as collateral. The paper system just lost its safety net. While the media talks about trade wars, our forensic data shows China is executing a pincer movement. They aren't just dumping their bonds, they are using secret custodian accounts in Belgium to vacuum up every physical ounce left in the West. They are trading paper promises for the only asset that can't be frozen, physical bullion. We are now entering fiscal dominance. The math says we hit a delivery default by February 27th. In a world where the banks have $600 billion in hidden losses and the insurance is gone, your paper investments aren't protecting you. They're exit liquidity for the elite. Today, I'm showing you the plumbing of the collapse and the exact price targets for the greatest wealth transfer in human history. Here's what you can't see in your retirement account statement. On January 26, 2026, gold smashed through $5,000 per ounce, the third major milestone in just 10 months. While your advisor keeps you in the same 60-40 portfolio, Poland's central bank quietly positioned itself to join the world's top 10 gold holders. Not the United States, not China making headlines. Poland, a country most Americans couldn't locate on a map, is making moves that will reshape global financial power, and your advisor hasn't mentioned it once. While retail investors like us check quarterly statements and trust the same tired advice, central banks are executing the largest coordinated wealth protection strategy in modern history. They're not tweeting about it. They're not waiting for permission. They're just doing it. Let me show you the numbers behind that pincer movement. China has systematically reduced its U.S. Treasury holdings down to $682 billion, the lowest level since 2008. But they didn't just sell American debt and sit on cash. According to the World Gold Council, they bought gold for 14 consecutive months. The world's second largest economy looked at U.S. Treasuries, the asset every textbook calls the safest investment on earth, and chose the metal instead. This is the largest geopolitical asset swap in modern history. Pop quiz. What percentage of official global reserves does gold represent right now? Take a guess. Most people think maybe 5%, maybe 10% at most. After all, we've been told for decades that gold is a barbarous relic, that modern finance evolved beyond such primitive stores of value. The answer is almost 20%. Central banks now hold gold, representing nearly 1/5 of all official reserves worldwide. Just 2 years ago, that number was 15%. In 24 months, the world's most sophisticated financial institutions, the ones with armies of economists and access to data we'll never see, increased their gold holdings by 1/3. But it gets better. The Bank for International Settlements conducts annual surveys of central bank reserve managers. These are the people making trillion-dollar decisions about where governments park their wealth. In the latest survey, 95% of respondents expect their gold reserves to increase further. Not might increase, not considering increasing, expect to increase. Have you ever seen 95% of financial professionals agree on anything? Yet when it comes to accumulating gold, there's near universal consensus among the people actually managing sovereign wealth. Meanwhile, your financial advisor probably mentioned gold exactly 0 times in your last annual review. When 95% of central banks tell you they're buying the same asset, that's not a prediction. That's a coordinated global strategy. The data from the World Gold Council shows these institutions aren't just dabbling either. They're going all in with a conviction that should terrify anyone paying attention to what's not being said in mainstream financial advice. You want to know the difference between how central banks protect wealth versus how retail investors get told to protect wealth? Central banks are buying assets that can't be printed, can't be frozen by hostile governments, and can't be devalued by a single nation's monetary policy. Meanwhile, we're being told to trust in paper promises, backed by the same governments that are quietly exiting those exact same promises. According to Federal Reserve data, the average American has roughly 60% of their investable assets in stocks and 40% in bonds. That 60-40 portfolio has been the gold standard of financial advice for decades. It's simple, it's clean, it backtests beautifully. And it is exactly what central banks are moving away from as fast as possible while the collateral system shows its first cracks. Central banks aren't subject to the same marketing pressures as retail financial services. They don't need to make their strategy sound comfortable. They just need it to work. And right now, what is working is accumulating the one asset that's been money for 5,000 years, while everyone else holds assets that have been money for 50 years. Here's the math that matters. If institutional money is flowing into gold, and the data conclusively shows it is, then it's flowing out of something else. The World Gold Council reports that central banks added over 1,000 tons of gold to reserves in 2024 alone. That's 1,000 tons of value that used to support bond prices, that used to flow through the traditional financial system. Think about what that means in the context of a collateral blackout. When Lloyds won't insure sovereign debt from 12 major nations, those bonds can't serve as collateral in the overnight lending markets that keep the financial system liquid. Banks need collateral to borrow. Hedge funds need collateral to trade. The entire shadow banking system runs on the assumption that government bonds are safe collateral. What happens when that assumption breaks? Central banks already know the answer. That's why they're accumulating the one asset that doesn't need insurance, doesn't need a counterparty, doesn't need anyone's promise to perform. Gold is collateral that can't experience a blackout. It's the ultimate settlement asset when paper promises fail. When smart money exits before retail investors figure it out, the gap between those two moments determines who preserves wealth and who loses it. Right now, you're watching institutions reposition in real time, while your advisor sends quarterly reports about staying diversified and thinking long term. Those reports don't mention that the Federal Reserve's cushion hit zero. They don't explain what it means when the world's insurance capital stops backing government debt. They certainly don't connect those dots to why gold just broke $5,000. Right now, in January 2026, we're watching that gap form in real time. Central banks have been net buyers of gold for over a decade, but the pace accelerated dramatically after 2022. According to the World Gold Council's data, monthly purchase volumes more than tripled compared to the prior decade. This isn't a trend. It's a stampede in slow motion. These institutions aren't buying gold because they read conspiracy blogs. They're doing it because they have access to data about currency stability, debt levels, and geopolitical risk that we'll never see. When you're responsible for protecting an entire nation's wealth, you can't afford to be wrong about what comes next. The financial system works on trust. Trust that the dollar will hold value. Trust that bonds will pay you back. Trust that the rules won't change mid-game. But when Lloyds pulls insurance on sovereign debt, when the reverse repo facility hits zero, when China rotates out of treasuries for 14 straight months, that trust is evaporating in real time. That's what the gold price breaking $5,000 is telling us. That's what Poland positioning to join the top 10 holders means. The people who know the most are voting with the biggest dollars they control, and they're voting for the one asset that doesn't depend on anyone's promise to perform. Your financial advisor works in a system built on those promises. Their entire business model depends on you trusting paper assets managed by the same institutions that are quietly exiting their own exposure. So here's the question you need to ask yourself. If central banks controlling trillions of dollars are moving away from the exact portfolio allocation your advisor recommends, and if the collateral system is experiencing a blackout that makes paper promises worthless, who's actually looking out for your financial future? The institution buying gold like there's no tomorrow, or the advisor who hasn't mentioned any of this since you opened your account? Now, let me show you exactly how this is playing out with numbers that are so specific, so documented, that no one can dismiss them as speculation. Because when Poland announces they're buying more gold than Switzerland holds, when JP Morgan tells their institutional clients to position for $5,400 per ounce when the world's central banks triple their purchase rate overnight, that's not theory. That's forensic evidence of a financial system in transition. On January 21st, 2026, Poland's national bank did something that should have been front-page news in every financial publication. They approved a plan to purchase 150 tons of additional gold. Let me put that in context for you. 150 tons isn't some token diversification play. At current prices, we're talking about a $23 billion commitment from a country most Americans think of as a former Soviet bloc nation struggling to modernize. But here's what makes this absolutely critical to understand. Poland didn't just announce future intentions. According to the World Gold Council's verified data, they already purchased 102 tons in 2025, the largest declared sovereign purchase globally that year. They executed first, then announced they're doubling down. That's 102 tons already secured, with 150 more tons incoming. Do the math. That's 252 tons total, which would vault Poland past Switzerland as current holdings and plant them firmly in the global top 10 gold holders. Think about what that means from a geopolitical positioning standpoint. Switzerland built their gold reserves over generations, through 2 world wars, through the Cold War, through every financial crisis of the 20th century. Poland is matching that position in less than 2 years. This isn't gradual portfolio adjustment. This is a sprint to secure physical metal before the window closes. And they're doing it with the urgency of someone who knows exactly what's coming. You want to understand the pincer movement I mentioned earlier? This is the Eastern jaw closing. While China vacuums up physical metal through Belgian custodian accounts, Eastern European nations are building fortress balance sheets with bullion. They watched what happened when Russian assets got frozen. They saw how quickly paper claims became worthless when geopolitical winds shifted. They're making absolutely certain their reserves can't be frozen, can't be sanctioned, can't disappear with a phone call from Washington or Brussels. But Poland isn't acting alone, and they're not even the most aggressive buyer. The World Gold Council's data shows central banks globally are averaging 60 tons of monthly purchases. 60 tons every single month. Let me contrast that with historical norms so you understand how radical this shift is. Before 2022, central banks were buying an average of 17 tons per month. We are now seeing purchase volumes that are 3.5 times higher than the prior decade's baseline. 3.5 times. That's not a trend adjustment. That's not portfolio rebalancing. That's a fundamental reassessment of what constitutes safe reserves in a world where the collateral system is breaking down. When 60 tons per month becomes the new normal, and when countries like Poland are deploying tens of billions in concentrated bursts, you're watching the market foundation shift in real time. Now here's where it gets even more interesting. This isn't just central banks anymore. Western investment funds added 500 tons through gold ETFs in 2025 alone. 500 tons of institutional money flowing into exchange-traded products backed by physical metal. These aren't retail investors buying gold coins in a panic. These are pension funds, endowments, and sophisticated money managers looking at the same data central banks see and reaching the same conclusion. What conclusion? That gold needs to be part of the portfolio architecture right now, not eventually, not when conditions improve, but immediately. And they're not nibbling around the edges either. 500 tons through ETFs represents over $20 billion in new institutional demand, separate from and in addition to the central bank purchases we just discussed. Think about the timing here. This surge in ETF demand happened while your financial advisor was probably still pitching you on the benefits of total return bond funds, while CNBC was analyzing tech stock valuations, while the financial media focused on everything except the most important asset allocation shift happening in the institutional world. 500 tons of smart money silently repositioned, and the retail advice industry acted like nothing changed. But some institutions aren't staying silent anymore. JP Morgan, one of the largest and most politically connected banks in America, raised their gold forecast to $5,400 per ounce by December 2026. Not 2030, not some distant future projection. December of this year. That's 11 months away. And they're telling their institutional clients, the clients who actually move markets, to position for another 8% upside from already record prices. Goldman Sachs published similar projections. When both JP Morgan and Goldman Sachs align on commodity forecasts, you need to understand what that means. These banks don't make money by being right in their public research calls. They make money by positioning their proprietary trading desks ahead of the moves they're forecasting. When they publish $5,400 targets, they've likely already positioned for $6,000. The public forecast is the breadcrumb trail showing you where they've been, not where they're going. According to their research, which you can verify through their publicly available commodity reports, both banks cite the same drivers: sustained central bank demand, geopolitical fragmentation requiring non-dollar reserves, and structural deficit in mine supply versus demand. That last point is crucial. The gold mining industry can't increase production fast enough to meet this new institutional demand. You can't just drill more gold wells like you can with oil. Major deposits take a decade to bring online. The supply side is essentially fixed, while demand accelerated 300% overnight. What happens when you have fixed supply and exploding demand? Basic economics says price has to adjust higher. But here's what makes this different from normal commodity cycles. This isn't temporary demand from jewelry or industrial use. This is permanent demand from institutions that never sell. Central banks don't flip gold holdings for quarterly gains. They accumulate for generational security. Every ton that moves from private markets into sovereign vaults is essentially removed from circulation forever. Now let me show you the most important shift that almost nobody is talking about. Gold has officially overtaken the euro to become the second largest reserve asset globally. Read that again. Gold is now more important to central bank reserves than Europe's entire currency. Only the US dollar ranks higher, and given everything we've discussed about collateral blackouts and treasury liquidations, how long do you think that dollar dominance lasts? According to the International Monetary Fund's COFR data, that's the currency composition of official foreign exchange reserves database, gold now represents a larger share of global reserves than all euro-denominated assets combined. The euro, the currency of the world's largest economic bloc, the currency that was supposed to challenge dollar hegemony. Gold just leapfrogged it in importance to the world's financial authorities. This happened quietly. No dramatic announcement, no emergency summit. Just month after month of central banks buying gold and reducing euro exposure, until one day the math shifted and gold became the clear number 2. The Bank for International Settlements documented this transition in their latest quarterly review, and the financial press barely covered it. They were too busy analyzing Fed interest rate probabilities to notice that the entire reserve currency hierarchy just reshuffled. You want to know what this means for you? It means the very structure of the international monetary system is evolving away from paper claims toward hard asset settlement. It means, when push comes to shove and real value needs to move between nations, increasingly that value moves in gold rather than currency transfers that can be blocked, frozen, or devalued. Remember how I mentioned earlier that Lloyds pulled insurance on sovereign debt from 12 nations? That insurance exists because counterparty risk is real. Nations default, currencies collapse, geopolitical relationships fracture. In that environment, you need collateral that doesn't depend on someone else's promise to perform. Gold is that collateral. Always has been, always will be. The insurance crisis is simply forcing market participants to acknowledge what central banks already knew. The math supports everything I'm telling you. Before 2022, central banks were buying 17 tons per month. Now they're buying 60 tons per month. Before 2022, gold represented 15% of official reserves. Now it's almost 20%. Before 2022, the euro outranked gold in reserve importance. Now gold is firmly in second place. Every metric points in the same direction. Every data point confirms the same pattern. Institutional money is abandoning paper promises for physical assets at a pace that has no historical precedent outside of world wars and currency collapses. Except this time, it's happening during relative peace and before an obvious crisis. The institutions aren't reacting to collapse. They're positioning ahead of collapse. That's the terrifying part. They see something coming that hasn't fully materialized yet, and they're buying protection now before price makes it unaffordable. Poland buying 252 tons. Central banks averaging 60 tons monthly. Western funds adding 500 tons through ETFs. JP Morgan and Goldman projecting $5,400. Gold overtaking the euro in reserve status. These aren't isolated events. This is a coordinated pattern of institutional behavior that tells you everything you need to know about where sophisticated money thinks the world is heading. And through all of this, your financial advisor hasn't called. Your quarterly statement looks the same. Your 60/40 portfolio sits unchanged. The gap between institutional positioning and retail awareness has never been wider. And that gap represents the wealth transfer opportunity and the wealth destruction danger of this generation. On one side of that gap are people who see what's happening and position accordingly. On the other side are people who trust the system to protect them and wake up one day wondering why their savings don't buy what they used to. The evidence is overwhelming. The documentation is irrefutable. The institutional behavior is unmistakable. What you do with that information determines which side of the wealth transfer you end up on. Here's the part where I stop showing you what happened and start showing you what happens next. Because the math doesn't care about your feelings, your portfolio, or your financial advisor's quarterly bonus. The math just is. And right now, the math is screaming something that most people won't hear until it's too late. Let's run a thought experiment. You wake up on December 31st, 2026. Gold closed the year at $5,400 per ounce, exactly where JP Morgan projected. Your retirement account is open on your laptop. What are you looking at? Your bond allocation, that safe, stable 40% your advisor promised would protect you from volatility, is down. Not crashed, just down. Because when gold hits $5,400, that means real yields stayed elevated or went higher. Bond prices move inverse to yields. Math doesn't negotiate. Your bond position that was supposed to be your safety net just cost you purchasing power during the exact moment you needed protection. Your stock allocation isn't faring much better. Higher real yields mean companies face increased borrowing costs. Growth stocks that thrived in the zero-rate environment get repriced. Value stocks struggle with margin compression. The 60% equity portion of your portfolio that was supposed to generate wealth is now fighting headwinds that didn't exist when your advisor built that allocation model back in 2015. But here's the really painful part of this scenario. While you're watching your 60/40 portfolio tread water or decline, gold didn't just hit $5,400 and stop. It continued moving because the forces driving it higher didn't disappear. They accelerated. Poland deployed their $23 billion. China kept rotating. The insurance crisis spread. And suddenly, that allocation you ignored because it seemed too risky or too complicated or too different from what everyone else was doing, that allocation is the only thing preserving purchasing power. Now let me show you why this isn't speculation. It's mathematics. Gold currently represents 2.8% of total global financial assets. That's the number according to the World Gold Council's latest calculation, 2.8%. In a world with stocks, bonds, real estate, currencies, and every other asset class you can imagine, Gold is less than 3% of the pie. JP Morgan's commodity team, the people managing billions in institutional money, projects that gold needs to reach 4 to 5% of global financial assets to reflect its proper role in a fragmented monetary system. Not wants to reach, not might reach, needs to reach. That's their word. They don't use it casually. Let's do the math together. If gold needs to go from 2.8% to 4.5% of global financial assets, that's a 60% increase in gold's share of the total pie. But here's the critical part. The pie isn't static. Global financial assets are roughly $500 trillion. If gold needs to go from 2.8% to 4.5%, that means an additional $8.5 trillion needs to flow into gold. 8.5 trillion with a T. That's more than the entire GDP of Germany and France combined. That's more than the market cap of the 10 largest US companies combined. And that money has to come from somewhere. It comes from bonds. It comes from stocks. It comes from cash holdings and real estate and every other asset class that is currently overweight relative to gold. When $8.5 trillion rotates out of traditional assets into gold, what do you think happens to the price of those traditional assets? They decline. They must decline. Because you can't pull that much capital out of a system without affecting prices. This is the wealth transfer everyone keeps talking about, but nobody wants to explain with actual numbers. Now, factor in Poland's $23 billion commitment. That's just one country, one relatively small country that decided they're not waiting for permission or consensus. They're buying now, and they're buying size. What happens when 3 more countries announce similar programs? What happens when Saudi Arabia or India or Brazil looks at Poland vaulting into the top 10 and decides they want that same protection? The supply of gold available for purchase is finite. Annual mine production is roughly 3,000 tons globally. Central banks are already buying 60 tons per month, which is 720 tons annually. That's nearly a quarter of total annual production before you factor in jewelry demand, industrial demand, or investment demand. The market is already tight. Now imagine if institutional demand doubles from current levels because 5 more countries announce Poland-style accumulation programs. You want to know what delivery default looks like? It's not dramatic. There's no announcement, no emergency meeting, just a quiet failure to deliver physical metal against paper contracts. The February 27th date I mentioned earlier isn't a prediction. It's a mathematical probability based on current inventory levels at COMEX warehouses versus outstanding contracts requiring physical settlement. When registered inventory drops below a critical threshold relative to delivery obligations, something has to give. Either the price spikes to encourage holders to sell and restock the warehouse, or contracts default and settle for cash instead of metal. If it's the second option, every investor holding paper gold suddenly realizes they don't actually own gold. They own a promise to pay cash equivalent to gold's value. In a collateral blackout scenario, that distinction becomes catastrophic. Think about your own situation right now. If you own shares in a gold ETF, do you actually own gold? Or do you own shares in a trust that owns gold, subject to the trustee's ability to maintain custody, subject to the government's willingness to allow redemption, subject to a dozen counterparty risks you probably never read about in the prospectus? When Poland buys 102 tons, they take physical delivery. The gold goes into vaults in Warsaw. That's ownership. What you have is probably exposure, and exposure isn't the same thing when the system is under stress. The strategic window I keep mentioning is closing in real time. Not theoretically, not eventually, right now. Every month that passes with central banks buying 60 tons is another month where available supply shrinks. Every announcement like Poland's $23 billion commitment is another signal that attracts attention from the next country considering similar moves. Every uptick in the gold price makes headlines that eventually filter down to retail investors, who then start asking their advisors why they don't have exposure. By the time your financial advisor sends that quarterly newsletter explaining why gold matters and suggesting you consider a 3% allocation to precious metals funds, the repositioning opportunity that central banks exploited between 2023 and 2026 will have already passed. You'll be buying at $5,400 what Poland bought at $3,800. You'll be joining the crowd right when the crowd discovers there isn't enough supply to accommodate everyone at once. This is how every major wealth transfer in history operates. Information flows from those with access to those without access. Action flows from those with conviction to those seeking permission. And wealth flows from those who move late to those who moved early. The institutions moved early. Central banks moved early. The question is whether you are going to move while there's still time or wait until moving becomes expensive and difficult. Let me paint you one more scenario. It's March 2027, 15 months from now. Gold is trading at $6,200 per ounce. Poland announced they're buying another 100 tons. Turkey just disclosed they've been quietly accumulating through third-party purchases. India doubled their central bank reserves. The COMEX had 2 failed deliveries that settled in cash. Your advisor finally sends an email suggesting you allocate to gold, but now you're buying at prices 60% higher than today, while institutions that bought in 2024 and 2025 are sitting on massive gains. You're not making a bad decision at $6,200. You're just making the same decision that was available at $3,000, at $4,000, at $5,000. The decision is identical. The price is vastly different. And the difference between those two things is the cost of waiting for confirmation that never comes from sources that do not understand what's happening. The math tells you everything you need to know. 2.8% needs to become 4.5%. $8.5 trillion needs to flow into gold. Supply is capped at 3,000 tons annually, while demand already exceeds 2,000 tons from central banks and institutions alone. Poland is deploying $23 billion. The insurance market is pulling back, the collateral system is showing cracks, and your 60/40 portfolio was built for a world that doesn't exist anymore. I'm not telling you what to do. I'm showing you what's happening, what institutional money is doing, what central banks are doing, what the mathematics of supply and demand dictate. What happens next is a function of whether you see the pattern before the crowd sees the pattern, or whether you wait until the crowd validates your decision by making it too expensive to execute. The wealth transfer isn't coming. It's here. It's happening in 60-ton monthly purchases. It's happening in Poland's 252-ton accumulation. It's happening in 500 tons of ETF inflows. It's happening in JP Morgan forecasts and Goldman projections and gold overtaking the euro in reserve importance. Every data point I've shown you is evidence that the transfer is already in motion. The only question left is whether you're on the side that benefits from it or the side that funds it. And that question gets answered by what you do in the next few months, not by what you wish you had done when gold is trading at $6,000 and your advisor is finally telling you what I'm telling you now. February 27th isn't that far away. Neither is December 31st, 2026. The gap between those dates represents the window where individual investors can still position ahead of the crowd. After that window closes, you're not wrong to buy gold. You're just late. And in markets, late costs you everything.